By the end of this video, you'll know 5 more things I regret not knowing prior to starting my investment journey, and that you should know now so that you can be much closer to the goals you're looking to achieve. Later in the video, I'll also cover 2 more things you should be starting to do right now. They're so simple, but will have a huge effect on your potential returns. Hi, I'm Jim, and welcome back to the channel, where we help you make the most of the markets to achieve financial freedom. I've been investing for more than 10 years, both as an individual investor and as a professional, and I currently work in regulated markets for a stockbroker in London. Let's get straight into it with number 1, following trends. This ties in quite well to the company we just spoke about in the first video, Cycle AI. If you missed the first video, there's a link in the description. AI-focused businesses are very in focus right now, and the hype surrounding the applications is huge. While there's huge global attention on the sector, it can be a very interesting area to look at, but you should be very cautious when following trends. They are not always driven by interest, and are sometimes overhyped by the media, social media in particular. A great example of this would be the so-called meme stocks, GameStop being the primary there, whereby a large group of retail investors on Reddit pumped the price of GME in the mistaken belief that they were pushing large hedge funds out. To begin with, they were, but hindsight shows us that the hedge funds had all exited by the time the stock hit $200. The hype continued to drive the price up to around $500, a huge multiple on the business's actual value, and the retail individuals who were still buying here have since seen their shares plummet in value. A good lesson to us all in being cautious when following trends. If this has been helpful so far, please do throw the video a like, as this helps YouTube show the video to others that it might help, and if you're interested in more content like this, please do subscribe for more. Stock price movements are not always rational. Most economic theory is based on the belief that individuals behave in a rational manner, and that all available public domain information will be used to make investment decisions. This is often known as rational actor theory, and is a core principle of efficient market hypothesis. Very simply, this is the belief that the market prices assets in public markets correctly, and that there is little point in looking for value. Whilst there is a large body of data to support the theory, the simple existence of famously successful investors like Warren Buffett, whose returns under EMH are theoretically impossible to achieve, shows us that there are some issues with it. The truth is that investor behaviour is rarely as rational as we would like it to be, and this leads to emotional selling or buying. This can often lead to stocks moving up based on the hype surrounding a certain sector or company, the current AI boom being a great example of this, or down if the sector is unpopular for some other reason. Oil and gas explorers versus climate activists would be a good example of this. The big takeaway here would be that we should expect movements of stock prices beyond what might be expected by a rational and well-informed individual, both upwards and downwards, and it can be a crucial part of overall strategy to bear this in mind, in particular if you're being fairly active with position trades and reallocation of assets. As always, please remember that this is not financial advice, a recommendation to buy or sell, or regulated advice. There's a disclaimer in the description. If you do wish to receive regulated financial advice, please feel free to send me a mail and I'll be happy to speak with you on a regulated platform and assess suitability. Don't be surprised by volatility. This one's crucial to make sure you aren't feeling too anxious about investing. Stock price indices overall have shown a positive upwards trend over time. However, it's worth noting that intra-year declines of 10% or more are quite normal, even outside of years like the COVID pandemic or the 2008-09 global financial crisis sparked by subprime MBS or mortgage-backed securities, in particular in the USA. If we look at the data for the S&P 500, for example, from 1980 to the present day, we can see that most years we do see this decline occur at some point in time. It's highlighted in brown using this graphic from Fidelity. This can present an opportunity to buy if you've kept a cash balance aside for such situations, and as we can see they happen on a regular basis, the argument for doing so is strong. Keeping a cash balance. As we've just seen, keeping a cash balance can be crucial to your strategy, in particular when markets may be very volatile. And as we've just spoken about, the stock market is often irrational, and stocks may well move well beyond the expected range due to overselling and sentiment towards a certain company. A great example of this is Barclays plc, a UK and US bank focused on investment products. The company posted a £7.2 billion profit for the full year last year, which in current market conditions and with a market cap of around 22 billion would be considered very good free cash flow. However, the market were expecting a profit of 8 billion, and subsequently the company dropped by just over 10%. Quickly following this, the company's price then rose to 162, a 20% gain from the irrational lows seen after the results, and reflected the earnings potential of the company going forward. In situations like this, investors without a cash balance would not be able to benefit from these moves, which can be extremely important when looking at your total return. Management fees can destroy your profit. This one's quite simple, but very important. Management fees can range from 0 to 3% in some cases. Now, 3% might not seem huge, but over a lifetime of investing can make an enormous difference. Take a look at these 3 examples. Let's assume for all 3 that the rate of return is 10% pre-fees, and look at example fees at 0%, 1.5% and 3% over a 30-year period. We'll start with 10,000 in all 3 examples for reference, and for simplicity I'll simply remove the fee from the return basis. So we can see in our first example, with a 3% fee or 7% return, we get 81,164.97 after 30 years. In our second, with a 1.5% fee or an 8.5% return, we get 126,924.99 after 30 years. And our third, with a 0% fee or 10% return, we get 198,373.99 after 30 years. As we can see here, the difference between a low and higher fee, whilst it may not seem huge initially, can make a huge difference to your overall returns. Always ensure that the fees you are paying are justified by a great service. If they aren't, shop around to find a better deal. We'll now cover 2 things that I would do right now if I was in the first few years of my investment journey. Your job is your biggest asset. Okay, this one's really simple and might sound counterintuitive, so bear with me here. Your biggest asset when you begin investing is your income. You should focus initially on building your own income as much as possible. As we've seen earlier, compounding can be the make or break point for achieving or failing to achieve your goals, and is an incredibly powerful tool in your arsenal. Being able to put as much as you can into the markets in the earlier part of your journey, before it starts to really build itself over time, is going to be the biggest contributor to your portfolio growth. Let's take another look at a compounding comparison briefly to show this. So, if we start with 10,000, aim for 10% growth, and leave it there for 30 years, we would see the following. Now, 198,000 from a starting point of 10,000 isn't bad at all, I'm sure you would agree. However, let's see the change with both a small contribution and a larger one paid in monthly when our salary hits. We can immediately see that even adding a very small amount like $100 a month extra really helps to grow this, and it's normally a really achievable number for most people regardless of their age. A result of $424,422 really helps to show this, but let's see what happens if you can up your income and be able to contribute $1,000 a month instead. As we can see here, the results are pretty spectacular. $2.458 million. $2 million more than the small deposits of $100, and well over $2.2 million more than making no further contributions. I'm sure you'd agree that living off $2.4 million in retirement would be a lot easier than trying to live off a few $100,000. How much time should you spend? The next thing you should do right now would be to decide how much time you are realistically willing and able to devote to research. This may sound obvious too, but investing should be treated as a second job. That's only logical if you're intending on using it to supplement or provide an income, right? But most people are not prepared to spend large volumes of time reading financial statements, thinking about trends and geopolitical events. They're hardly exciting, after all. That said, These do give crucial insights into a company's performance metrics and are extremely important to note if you want to be successful. And this can take a large amount of time that not everybody has or is willing to sacrifice. And many get results that match the time and effort that has gone into picking a stock or fund, simply as they may not understand the reasons behind why a stock may do well or not. As the legendary investor Peter Lynch said, "If you can't explain to a 10-year-old in 2 minutes or less why you own a stock, then you shouldn't buy it." So the real question here is, should you use a broker or not? Simply put, if you don't have the time or are unwilling to sacrifice time to gain knowledge to improve returns, that's okay. There are plenty of brokerages that can help provide information, deal access that you may not otherwise be able to have, and of course execution services. These do come at a cost, but it can be very useful for many investors and should really be seen as a trade-off for your time. Thanks for watching, and once again, if this has been helpful, please do throw the video a like, as this helps YouTube show the video to others it might help, and if you're interested in more content like this, please do subscribe for more.